Is $100 enough to start trading gold? You've probably seen it. Someone turns $100 into a few thousand trading gold. Looks amazing. But here's the real question. Is that actually realistic or just one lucky trade? So in this video, we're breaking down what capital you actually need to trade gold sustainably. Gold, or XAUUSD, is one of the most popular instruments out there. It moves fast, it's liquid, it's exciting. But here's what beginners underestimate. Gold's price per pip is way bigger than most currency pairs. And that single fact changes everything about how much capital you actually need. We're covering why pip value matters, what happens when you're undercapitalized, and realistic capital ranges. Plus, how to calculate position size properly. Stick around, that part's the most important. First up, gold moves in bigger dollar increments than most pairs. In something like UUR/USD, a pip's worth around $10 per standard lot. In something like UUR/USD, but gold's price in whole dollar moves, a few dollars swing can mean a real difference in your account. In something like UUR/USD, but volatility is naturally higher can mean with gold. It tends to have wider daily ranges compared to most major currency pairs. Always remember to stick to your trading plan. That's part of why it's attractive. Bigger moves, bigger potential profits. But it also means your stop loss needs more room to avoid getting hit by normal noise. And that directly affects how much capital you actually need to trade it safely. This is exactly where undercapitalized accounts get wrecked. Volatility, you're stuck with two bad choices. If something like UUR/USD, volatility, you're stuck with two binormal movements. Or it's wide enough to make sense, but now you're risking way too much per trade. Let's talk about the mistakes that wreck small gold accounts. Mistake 1, trading full lot sizes on a tiny account. A lot of beginners see gold moving fast and get tempted to size up for quick profits. On a small account, that usually means 1 or 2 losing trades wipe out a huge chunk of your capital. So sizing down isn't boring, it's just survival. Let's talk about common trading mistakes. Mistake 2, ignoring margin requirements. Let's talk about common trading. Gold needs more margin per lot compared to most Forex pairs. If your account's too small, you can get margin called out, even when your analysis was actually right, simply because you didn't have enough room to absorb normal price swings. Mistake 3, revenge trading after a loss. This one's psychological, not technical. When your account's small, every loss just feels bigger. That pressure leads straight into revenge trading, one of the fastest ways to blow an account. Mistake 4, no real risk management plan at all. A lot of traders jump into gold without calculating position size. They just pick a lot size that feels right. On a small account, that guesswork almost always ends in oversized risk per trade. So yeah, these 4 mistakes are basically a sex. So yeah, are basically how small accounts disappear fast. All right, let's get practical. Here's a general framework, not a guarantee, but a realistic starting point. Based on standard risk management principles, consistency and discipline are key. First bracket, micro accounts. Somewhere around $100 to $300. This is the best way to start. This can technically get you started, especially with micro lots. But you'll be limited to really small position sizes, and your risk per trade in dollars stays tiny too. It's fine for learning and building consistency, just don't expect real income from this size yet. Next bracket, small accounts, around $500 to $1,000. This is where things start feeling more workable. With proper position sizing, you can take trades with reasonable stop distances without over-risking. Still best used for skill building though, not as your main income source yet. Next, semi-serious accounts, around $2,000 to $5,000. At this level, your position sizing has way more flexibility. You can use wider, more logical stops based on actual market structure. Instead of being forced into tight stops just to manage risk. But here's the real principle behind all of this. The exact dollar number matters way less than the relationship between account size, stop distance, and position size. A trader with $10,000 managing risk poorly can blow up just as fast as someone with 100. So the number's less important than the math behind it. Here's the actual formula that matters more than any account size number. Step 1. Decide your risk per trade. Usually 1 to 2% of your account, not more. Step 2. Figure out your stop-loss distance, based on market structure. Not on how much money you're comfortable losing. Step 3. Calculate your position size backwards from that. Your risk amount divided by your stop distance gives you the position size that fits your account. This is the part most beginners skip completely. They pick their lot size first, then just hope the stop and risk work out. It should always be the other way around. So here's the bottom line. Gold needs more capital consideration than most Forex pairs because of its pip value and volatility. Either undercapitalized accounts get forced into bad choices, either too tight stops or too much risk. A realistic starting range sits somewhere between $500 and $2,000, depending on your goals. But the exact number matters less than proper position sizing. Calculate your position size from risk and stop distance, not the other way around. If this helped clarify how much capital you actually need for gold, share it with someone wondering the same thing. Drop a comment with your current account size. I'll cover more position sizing examples soon. Thanks for watching. See you in the next one.